Hello, I'm Armand Hajian with 5 Key Capital Management. I'm coming to you today to talk to you a little bit about the recent tax legislation called the One Big Beautiful Bill Act that we got that passed through Congress back on July 4th of this year. We've had a little bit of time to take a look at the provisions of this bill, this reconciliation bill that was passed, and start to think about implications and get wait for a little bit of guidance to come out from the IRS on that. So today I want to talk about some of the big provisions, how it impacts families and small businesses. So uh, again, this reconciliation bill, one of the ideas behind it was it made permanent a lot of the provisions that appeared in the Tax Cuts and Job Act of 2017, or TCJA 2017 as it's often referred to. So basically what we're doing is we're keeping a lot of things in place. And when we use that word made permanent, or those words made permanent, what we're really referring to is until a future Congress decides to change it. Anytime you see a tax bill that's made permanent, it doesn't mean that it can't be changed later. And so, for practical purposes, you'd be looking at, the current administration still being in for another probably 3 years. You're looking at Congress, midterm elections next year. Probably the soonest you would see any major revisions to this would be 4 to 5 years down the road, if at that time at all. And so we can feel fairly confident, although never certain, that most of these provisions that have been quote unquote made permanent will be in place for at least the next several years. And so that once we kind of get an idea of what some of these rules are, we can utilize those rules for at least a few years before someone else, might change it or make adjustments to it or any big revisions. So the seven bracket structure is going to stay in place. And so there are seven individual income tax brackets in the US tax code. That's 10, 12, 22, 24, 32, 35, and 37%. That is a little bit less than what we had previous to 2017. And so we're going to keep those seven brackets. Overall, the overall theme is kind of a continuation of lower tax rates that we've basically seen since the 1980s. And on the next slide, I'm going to show you um, is a really good indicator of kind of where we are currently in terms of overall taxation. So going all the way back to 1913 at multiple times, you know, in the first part of the 20th century, we had tax rates that got up as high as 80, 90% for the top federal income tax level. Basically, what you see is starting in the late 1980s, mid to late 1980s, you see a pretty big drop off in the highest tax rate going all the way from 50% down to 30%. And then from there, it's kind of stayed around that level, gotten as high as around 40%. And so that 37% is the top rate, plus the 3 point, if you take the 37% top individual rate plus that 3.8% for the net investment income tax. That would get you to that 40.8 federal effective rate. This does not include, to be clear, does not include state tax rates, which are going to vary by state, obviously. So you've got an increase on the standard deduction in starting in 2025. So we will get that in 2025. Get a little step up this year over what we thought. Originally, it was supposed to be scheduled to be 30,000 for a married couple, 15,000 for a single filer this year. With this new bill, we're stepping that up to 15,750 for a single filer and 31,500 for married filing jointly for 2025. So that's going to be a little bit of additional tax savings in this year. And this provision will continue to be indexed for inflation moving forward. So you're going to continue to see those figures get bigger and bigger as the years go on that standard deduction. And again, we're going to talk a little bit about the impetus behind why they increase that standard deduction or what the implications are here in just a moment. So charitable deductions. This is a little bit different. So we've got starting next year in 2026. Non-itemizers may deduct up to 1,000 for a single filer or 2,000 for a couple for charitable contributions, even if you don't itemize. So historically, you could only take a charitable deduction if you were itemizing. And we're going to talk about what are the big four for itemized deductions. But typically, you had to itemize to get that. Not anymore starting next year. You can do 1,000 or 2,000 for a couple for married, or excuse me, for charitable contributions that you can take a deduction on. So that's new. During COVID, they had a provision that let you do this for 1 year. I think it was in 2020 or 2021. I can't remember which, but you got a $300 one-time deduction for non-itemizers, and then it went back away again. So now this is kind of bringing that back and putting it into place starting in 2026. Itemizers may still deduct their charitable contributions up to the annual limits, but they've now put in a new provision that imposes a 0.5% floor on deductibility. And that's a 0.5% off of your AGI or adjusted gross income. So if you took, for example, someone that makes $100,000 of income in a year, a 0.5% floor would mean that you'd take that 100,000 times 0.5% and be a $500 floor, which basically means if you itemize and you gave, let's say, $2,500 to charity that year, you would actually only be able to deduct 2,000 because the first 500 would be under that floor. You have to hit that floor. Almost think of it like a deductible in a way. You have to hit that floor before you can begin to take the deduction. So that's a new provision. And this is a permanent provision. So again, use that word permanent. It means until somebody else changes it. On capital gains, a couple of things here to think about. So we're going to preserve separate treatment on capital gains from ordinary income. I believe there were some conversations about saying do away with those preferential rates on capital gains. In fact, I think there was a lot of conversations going on about what to do with capital gains. But we are going to preserve what we have in place on that, which is a 0, 15, and 20% bracket. If anyone wants to discuss what that means in greater detail, I think for the scope of this video, we'll keep it to this. But if you ever want to discuss that, I mean, this is one of the big, not secrets, but one of the big keys to the US tax code is that if you make money from the sweat of your brow, right, you go out and you earn this money, you're going to have to pay ordinary income tax, which are those higher rates that, yeah, they start at 10% and 12%, but quickly get all the way up to 37%, versus on capital gains, it's 0%, 15% on something. Don't quote me on this number, but it's something almost like 600,000 for married filing jointly of income. Below that amount's taxed at 15%. So until you're making like 600,000 plus, you're not even paying the 20%, you're paying 15%. So the idea is realistically, capital gains are staying the way they were. Although, if you are in the state of Missouri, there are no longer capital gains tax in the state of Missouri. They did away with that. And so, for on the sale of appreciated non-qualified assets, all right, so we call non-qualified is another way, fancy way of saying taxable assets. So, your IRAs, gains in your IRAs, if you bought and sold an investment, you don't get taxed on that anyway. Your 401ks, your IRAs, things like that. Typically on those, you're either getting taxed at distribution or you're not getting taxed at all in the case of a Roth IRA, for example, as long as it's a qualified distribution. So for state of Missouri, let's say in a taxable account, you bought a stock for $10,000 and you sold it later for $20,000. That capital gains tax that you would have been assessed typically within the state of Missouri will no longer apply. It's no more 5% on the sale of appreciated assets in Missouri. Again, you'll still be liable for the federal tax depending on whether it's a short-term gain. Of course, 365 days or less of a holding period would be a short-term gain. If you held the asset for 366 days or more, it would be a long-term gain, and you get those preferential rates, 0, 15, 20%. But the idea is Missouri is getting rid of the cap gains tax, and that's going to lead to some people saving some money there. Okay, the senior exemption. This is the one that will probably excite some people, I think. So again, this was a reconciliation bill, and the idea was trying to reconcile all of these if you want to call them, discussions or conversations that we had had over the last couple of years. We're trying to kind of tie some of those out. And so you think about this conversation about no tax on Social Security. They couldn't get that through. So what they got, this is the next best thing. And so this is a $6,000 personal exemption for people over the age of 65, 65 and up, I should say, because 65 is included in that. So if you're 65 or older, you're going to get a 6,000 personal exemption. Think of this as an above the line deduction, above and beyond. Or I should let me say, like another part of your standard deduction, I should say. It's like extending your standard deduction. I don't want to misspeak and say above the line. But this is a $6,000 personal exemption, 65 plus. There's a phase out. So if you're single and you make more than 75,000, or if you're married and you make more than 150,000, this will phase out. But for those folks that are under those thresholds, it's going to increase your standard deduction. So this is going to expire at the end of 2028. So we're going to have this one for just a few years. I assume they're going to try to revisit, I don't want to speculate too much, but I assume they'll try to revisit this and figure out how could they potentially either make it permanent or could they go back and try to put another bill through to try to not tax it in the future. And you say, well, who did this bill help or who did this portion of the bill help? Well, certainly help those 65 and up. I would say that your crowd that is between the ages of 62 and 64. So your 62-year-olds, 63-year-olds, and 64-year-olds that are currently on Social Security really got the short end of the stick here because, we talked about no tax on Social Security. And of course, you can take Social Security starting at age 62 if you decide to take it early. Obviously, you get a little bit less than if you waited till your full retirement age. But if you did decide to take it at 62 or at 63 or at 64, you're not getting this tax benefit. You're not getting no tax on Social Security. You're still potentially liable for tax on up to 85% of your tax of your Social Security benefits. And now you're not getting this exemption until you turn 65. So for that crowd, I feel for you. You got left out in the cold on this one, unfortunately, and that is really tough, and I sympathize with that. Okay, so what does this mean? Okay, so again, base standard deduction for a single filer for this year is 15,750. Okay, if you are already over the age of 65, you were already getting as a single filer a $2,000 senior deduction, and now you're getting this bonus $6,000 deduction, which means a single filer that is over the age of 65 is now going to be getting a standard deduction of $23,750. A married couple, same setup, you're getting a $31,500 married standard deduction, $1,600 on top of that for each of the people in that, you get 1,600 times two, and then you get 6,000 times two. So you're talking about, let's see, a married couple, both over the age of 65. Yeah, you're getting 3,200 for your senior deduction. You're getting 12,000 for your bonus deduction, which means your total standard deduction for that married couple over the age of 65 or 65 and up is a $46,700 standard deduction. In other words, the first 46,700 of income is not getting taxed because that's all going to get wiped out by your standard deduction now, which is fantastic. I think this is going to affect a lot of folks that are 65 plus in a very positive way. It is going to drastically reduce, in some cases, your tax bill. And I think that's great. Again, now there's that cap, there's that phase out. So if you're above 75,000 of individual income, 150,000 of joint marital income, and you're over the age of 65, you'll start phasing that out and you won't get this as much of it until you eventually, when you hit the full phase out, you won't get any of it. But for those folks that are under those thresholds, it's going to be a big deal and it's going to help out a lot. So huge change there. SALT. So SALT is a big change coming. So what is SALT? State and local tax. So for a Kansas City resident, someone who lives actually in Kansas City, Missouri, this would include your SALT would include your Missouri income tax that you pay at the end of the year, your Kansas City 1% Kansas City earnings tax, your annual real estate taxes, plus any personal property taxes you paid for cars, boats, trailers, you name it, anything that you pay on that property tax bill to the county at the end of the year. All those get added up into a bucket. Used to be that for an itemized deduction, an itemizer, let's say, somebody that was itemizing their taxes, they were capped. They could only claim a maximum of 10,000 for salt tax on that deduction. Now that cap is being raised to 40,000, and this currently is going to go from 2025 up to 2029. In 2030, it goes back to 10,000 unless, again, unless a future Congress, future administration decides to come in and extend this or change it or alter it in some way. It'll go back to 10,000 in 2030. So this deduction will phase out for taxpayers with a MAGI, a modified adjusted gross income between 500,000 and 600,000. So once you hit that 500,000, you're going to start losing 1% of that deduction per $1,000 you make up to 500,000. Okay. And so that means it's going to phase out. And by the time you've hit 600,000, you're not getting, you're going back to 10,000. So that's kind of the idea behind that. And so this salt tax, what this is going to do, I think to review what you can do when you itemize, it's helpful to just kind of start with those basics. There's four primary things that you can deduct when you itemize. So the first one is your mortgage interest. The second one is that salt tax, which now that cap went from 10,000, you can actually claim up to 40,000 as long as you're below those income thresholds. Your charitable contributions are deductible up to certain limits of AGI. So depending on what type of asset that you're gifting or donating to charity, it's based off of your AGI. Some assets like cash have a different cap versus appreciated stock versus artwork versus, things that have specific purposes. Like if you're donating something to a museum, there's different deductions that you can take. But the idea, and that goes beyond the scope of this video, and I would consult your tax advisor about something like that. But your charitable contributions are in there. And then out-of-pocket medical expenses above 7.5% of your AGI can be added to this bucket. And you say, well, what does that mean? Well, you take your AGI or adjusted gross income. Let's say, for example, you make 100,000 of household income. 7.5% of your AGI would be $7,500. So you can only start to deduct out-of-pocket medical expenses. That does not include your premiums that you pay for insurance coverage. This is your out-of-pocket expenses. So, doctor bills that you had to pay to meet your deductible, procedures that you had done, things that you bought at the pharmacy, et cetera, et cetera. Out-of-pocket medical expenses, if you have 100,000 of income, that means the first 7,500 of those expenses are not deductible. So let's say you had 10,000 of out-of-pocket medical expenses, you could only deduct 2,500. The first 7,500, just like that floor that we had on charitable deductions before, same idea. So again, the idea is what you do is you calculate all four of these things, what you have for deductions on all four of these, and you add them up. And if you add those up and these four things are that number that you get is larger than the standard deduction amount, then you would itemize. If it's not, then you would not itemize. And again, it's important that if you're thinking about itemizing, not only does the itemized deductions need to be larger than the standard, it also needs to be kind of significantly larger. And what I mean by that is this. Most CPAs and tax preparers, if you decide to itemize, that's more forms, that's more work for them. They're going to charge you more money. So if you say, well, my standard deduction is going to be $31,500 for a married couple, let's say, it's going to be $31,500. If I add those four categories up, if I were to itemize, I have 32,000 in itemized deductions. Okay, yeah, that's $500 more, but what's your CPA going to charge you to itemize? Is he going to charge you $750 for additional tax forms that have to be filled out, plus their time and energy and labor? If that's the case, then you just take the standard deduction and move on. So in order to itemize, you really need to have, I say significantly, but I can't think of a better word to describe it. You need to have a margin between that itemized deduction, what you could take, and the standard. And why does this all matter right now? This is an important topic. I think not enough people are talking about this, and I wish more people were talking about this. This is going to matter for people because a couple things have happened. So interest rates were historically low for an entire decade, all the way through the aughts or the 2010s. Interest rates were on the floor coming out of coming out of the great financial crisis in 2007 to 2009. Let's say it's '08, but kind of that time period was all wrought with problems. Coming out of that, the Fed took interest rates down to zero and kept them there for a long, long time. And so many people bought houses for many years at very, very low mortgage interest rates. And that kind of became the new norm. Everybody got used to it. Well, of course, we know um, confluence of events. You're coming out of COVID. You're trying to stimulate the economy. Both the Fed and Congress take stimulative action, and of course, we cause a massive inflation that we haven't seen, really since the late 1970s, early 1980s. You get this 9% at the peak, 9.3%, I believe, was a peak CPI number. And so you get this massive inflation coming in 2022, and they've got to raise rates. Okay, so now mortgage rates are much higher. We all know that. Okay, well, what does that mean? It means that potentially for, when they created these higher standard deduction amounts, back in 2017 or 2018, when they said let's increase the standard deduction amounts, that's all fine, well, and good. And the idea behind it was designed to say, let's not have so many people itemizing. It's making the IRS work too much. It's making everybody else work too much. Let's make it the standard deduction higher, assume that everybody's going to have a certain amount of deductions. Let's just make it higher and make it to where 85 or 90% of people just take the standard deduction. Those are approximations that I'm making. I don't know the exact data off the top of my head, but the idea was really to target the vast majority of people not having to itemize. Okay, so they make those rules in a period of time when mortgage interest was not really a huge issue for many people. Okay, well, now you have an environment where if someone has bought a $500,000 house or a $700,000 house in the last couple of years at 7 or 8% mortgage interest rates, on a 30-year loan, this person might be paying $30,000, $40,000 a year in mortgage interest because they're on the front end of a 30-year mortgage. Rates are higher and it's a big balance. But home prices have also, right, increased, which is my point number three right there. Home prices have increased. And so that causes those purchase prices to be larger. In other words, people are paying more in mortgage interest. So that first line, if you go back, that first item might be bigger than it's been in the past. Okay. Um, Again, because Missouri has a 5%, pretty close to a 5%. That's not exact. That's a roughed in number, but approximately 5% state income tax. KC has a 1% earnings tax. Again, if you have purchased a home that has risen in value and your property values have been reassessed at larger numbers, you may be paying more in property taxes. You may be paying more in state and local taxes. And, cars haven't gotten cheaper either, by the way. And so you're probably paying more in personal property taxes. So, so you may have cause to have a higher mortgage interest deduction. You may have cause to have a higher SALT deduction. Many families, I think, in Kansas City may well breach that 10,000. Okay, and basically the idea was for the last several years, it's been a very laissez-faire approach to tax planning, saying basically, hey, look, everyone's going to take the standard deduction. And when I say everyone, I mean most everyone is going to take the standard deduction. That's not necessarily true now. My contention is you got to get with a CPA, you got to get with a financial planner, you got to get with some people and start to talk about these things and say, what could I itemize? Could I itemize? And could this save me money? Because I think the answer for more people than realize it is yes. I think that you might be able to save money by itemizing, but you've got to take a look at your individual situation and what you have going on. This whole idea of this new salt cap is a big deal. Who did it help the most? Well, obviously, if you're in a state that has a really high state income tax, so think California with 13% state income tax, New York, New Jersey, like 10% state income tax, those people are really going to be able to take advantage of this. States like Texas and Florida, Arizona that don't have state income tax, they won't benefit as much from this SALT. Although in some of those locations, maybe you have higher home prices, mortgage interest deduction is larger, things like that. But overall, in Kansas City, I really, really believe, truly believe that there are people that could benefit from taking a second look at the potential to itemize. Child tax credit. Child tax credit is we've got a permanent increase to 2,200 per child, with 1,400 of that being refundable. We're going to phase that child tax credit out if you're a single filer, you make more than 200K, or a married couple filing with more than 400K of joint income. You're getting phased out on those child tax credits. But for the folks that are below those thresholds, children going to get that 2,200 per child deduct credit, excuse me, credit, and 1,400 fully refundable. Trump accounts. You may have heard about these in the news a little bit. Um, Here's what I can say about Trump accounts. We don't have great guidance just yet. And I think most financial planners that I've spoken to are kind of taking the same approach. My understanding, by statute, you can't open one until July 2026, on the 1 year anniversary of the signing of this bill anyway. We don't have clear guidance on, who's gonna, which custodians are gonna have access to these accounts. Maybe we will. We just don't know yet. We don't know which custodians will have access. We don't know what the investment options are going to be. I have heard, though no official confirmation on this, that it will be mutual funds that you can invest in inside of these accounts, but no clear guidance on that. The idea of these Trump accounts is for children that are born between the years 25, so this year, and the year 2028. They're going to get a one-time tax credit for contributions to a Trump account. The idea is baby is born, let's say this year, mom and dad or grandma, grandpa, whoever can put $1,000 into this Trump account for this baby when they're born, and they're going to get a one-time tax credit. Okay, that's dollar for dollar reduction of tax. So it's effectively the government is putting this money in for this child, and it's going to be invested in some sort of mutual funds. And the idea is that those mutual funds are going to grow over time for benefit of that baby. Parents and grandparents can also contribute an additional $5,000 to this account for the child per year. There's a $5,000 annual cap that you can put into this. The child can't touch it until age 18. At 18, they're able to withdraw funds if they want to, but it would be treated like an early IRA distribution if they did. Um, my understanding is that these Trump accounts are more so for retirement funds for the child. I believe there will still be some exceptions, though don't quote me on that one because I haven't read through I'm still in wait and see mode on this. I haven't read all the provisions. There may be similar treatment to IRAs for like first-time home buyers or for education expenses, things like that, some exceptions to that. But here's where I stand on this. And I would say for me, I'm talking about it because I want to make people aware that it's out there. I would say I have more questions than answers on Trump accounts at this point. 529s were updated quite a bit with Secure Act 2.0, which expanded the utility of those 529 accounts. I'm not sure what the use case for a Trump account is just yet. I'm not saying that there won't be something that we could figure out, a use case for it. But I'm sitting here going, well, with the 529s now, you're able to make a contribution to a 529. State of Missouri offers tax parity, and allows you to take a deduction on up to $8,000 per year per contribute for a contribution, which means that at a 5% state tax, you could potentially save $400 off your Missouri tax return if you contributed the maximum amount to a child's 529 account, and the parents can double that up, and get a little bit more use out of that. So you can basically say, okay, well, um, I can do a 529. You say, well, what's the biggest knock on 529's always been? It's always been, okay, this is for 529 is a college savings plan. It's for college. Now, certainly the expansion of being able to use it for K through 12 made it more appealing to people. You can use your 529 funds to pay for K through 12 education, private school, whatever. But the biggest knock has always been, well, what if my child doesn't use these funds for education? I'm saving this money for benefit of my child, but I don't know what am I supposed to know what my kid's going to do when they're 1 year old or 2 years old? Am I supposed to predict what they're going to go to college and do someday, or even if they're going to go to college? So what if I put all this money in here? And of course, with 529s, previously, if you withdrew the money and it wasn't used for educational purposes, wasn't for qualified education expenses, you're paying big penalties, 10% penalty plus earning tax on the earnings. Nobody liked that, or at least a lot of people didn't like that. They said that's a little bit risky. I don't know if I want to do that. So the idea is with Secure Act, we get this provision now where you can convert $529 that are unspent up to $35,000 of lifetime $529 up to the annual contribution limit. You can start converting those over to a Roth IRA for benefit of the child. So it kind of accomplishes, it's like, hey, I can use it for education. I can take a tax deduction now. I've got some utility here. If they don't use it, we can roll it to a Roth. I'm just not sure yet what the use case for these Trump accounts will be. I've really got to put some time into thinking about different things as we get more clarity on it before I can give a definitive answer. But again, wanted to throw it out there because it was one of the big provisions in the bill and people will be talking about it. And I don't want clients of mine to be saying, well, hey, I've heard about these, but Armand hasn't told us anything about them. Small business provisions. This is some exciting stuff for my small business owners out there. This is great. So, a couple things. You've got Section 199A, which we lovingly refer to as QBI or Qualified Business Income Deduction, is extended permanently. Again, means until somebody comes in and knocks it out. Again, the idea of QBI, if you're not familiar with it, if you're a small business owner, it puts you on parity with corporate tax rates. Corporate tax rates went from 28% pre-TCJA down to 21% now. And so the idea is, well, oh, okay, if you're a pass-through entity, if you have an LLC or you're a sole proprietor, and you're taking income as a business owner as if it was an individual tax return, why, if I have a good solid business, why am I paying 37% taxes while Amazon and Microsoft and Google, let's say, the big corporations in America, are paying 21%? Didn't seem fair, so they put in this QBI, which just says if you're passing income through, let's say you're an LLC, you're passing this income through on your Schedule C, dropping it into your 1040, you're going to take a 20% deduction off of your net income from the business. So you take your net income, whatever the business nets, 20% automatic deduction off of that for QBI. So that's a big one for the small business owners out there. This extends something that has benefited you. This again gives small business owners the opportunity to compete in a competitive global economic landscape now. And so this is a good one for those people that are trying to start a small business. Also, we're going to reinstate the 100% bonus depreciation for property acquired after January 19th and before January 1st, 2020, or excuse me, 2030. Let me unpack this one a little bit. So the idea was we had put in this accelerated or bonus depreciation provision a while back. Basically, for a while, you were able to, if you had an asset that you placed in service for your business, let's say you bought a company truck that you use for business, or you bought equipment, as you see right here, the tractor or the machinery, okay, and this is used for your business. Under the old provision, there was a scale, and for a while you were able to basically able to depreciate the full purchase price of that asset in year one, and then it eventually scaled down to 80% and then 60% and 40%. And you say, well, what is the benefit of this? The benefit is if you're trying to grow a business and you're investing capital into your business to purchase assets that are going to be used to grow that business, you're getting a huge tax deduction up front if you can depreciate the entire value of that asset. Now, this is why you got to consult a CPA, because there is depreciation recapture to worry about on the back end. If I buy if I go out and buy a piece of equipment and I depreciate it down to zero in the first year, and then the second year I go out and sell that for more than zero, there's going to be some depreciation recapture. So attempt, I would not attempt, and I would not advise anyone to attempt to try to deal with bonus depreciation or anything to do with depreciation without consulting a CPA. because it gets very complicated. But the general idea is this extension of this allows, again, small business owners to invest in their businesses, to put capital into their businesses and take that depreciation expense for a little bit longer, at least up until January 1st of, well, excuse me, before January 1st of 2030, which means all the way through December 31st of 2029. So I cannot, on these small business provisions, just overstate how important getting a good CPA is to having success at utilizing these types of provisions. And so, with that, that's kind of everything that I had. Your questions are certainly welcome, appreciated. Would love for you to reach out if you have specific questions about your situation. I would love to schedule a meeting with you and go over any of these provisions with you in more in depth on anything that may be relevant to you. If you know of anyone who has questions about this, or you've talked to someone and there's some confusion around this, I'd love to speak with them. Feel free to share my information with those individuals. I'd love an opportunity to speak with them and help them out with some of these things. And then if you like this video, feel free to like and subscribe. I do want to start to put out a little bit more content around financial planning via my YouTube channel. So again, if you like the video, like and subscribe. We appreciate it. And thanks. Have a great day.